fund managers have created most of the alpha historically. The age of the superstar fund manager has gone to my mind.
Do you think markets are discounting or rather underestimating the geopolitical risks that we are living through, or as always markets are always right?
India is in a once in a generation kind of macro improvement. Why I say that is low growth meeting high liquidity, I think, is a recipe for small caps to do well.
Some of the stocks we know so many years even after IPO, they have not touched the IPO price. So how does one select what is going to work?
Institutional investing is football, not tennis.
Hi friends, welcome back to another episode in our podcast series. Today we have Manish Gunwani with us. Manish, of course, needs no introduction. CIO Equity at Bandhan Mutual Fund. Welcome, Manish.
Thanks for having me.
So, and just for reference, Manish has had more than now 30 years of experience post he passed out from IIM Bangalore. That was 96, right?
Yeah, you're making me feel old.
I'm making a statement that you are so experienced and has been an entrepreneur himself, and now post having a lot of accomplishments at first, as I say, Prudential Mutual Fund, then as head of equities at Nippon, and now head of equities at Bandhan. So welcome, thank you so much, and we are at your beautiful office in Mumbai. So Manish, I'll straight get on to our first track, and which I was itching to ask you, and hence I was pestering you for this podcast. Is Bandhan's performance of late has been really exemplary, if I can use the word. So what's the secret sauce?
So there's a statement I believed in, which is that today institutional investing is football, not tennis. And I think it's different from what was there 20, 30 years back. So I think today, if you want to do well at scale, you need a big, strong, solid team. And in general, we tend to make fund managers glamorous, right? But I do think that today it's not possible. The age of the superstar fund manager has gone to my mind.
Okay.
Because
I hope your colleagues agree.
no, fund manager is always important, but all I'm saying is they go 20, 25 years back. The markets were simple. You may remember that the Sensex had steel stocks, cement stocks, IT services, which are very similar. You understood one company in the industry, you understood everything else. Now, if you look at S&P 500 today, Apple, Google, Nvidia, super complex companies, right? So no one can understand 500 stocks in S&P 500 by one or two people. You need a team of 10, 15 people to really get the benchmark right, which is similar to what was happening in India, I think. So just coming back, what I feel, and having said that, it's just been 2 years, so we shouldn't read too much into it. Hopefully, we've got off to a good start, and we'll maintain that hopefully. But the philosophy is build a strong research team. If you think about 100 units of alpha, we want 70, 80 to come out of research and 20, 30 to come out of fund management. In general, Indian industry, fund managers have created most of the alpha historically.
Yeah.
Which is why we have this glamour around fund managers. But I do think that today the markets are so complex and the price discovery is so fast. There's a super efficient market. So you need to basically go to specialization. It's almost like Henry Ford's conveyor belt.
Yeah.
Each person does 50 stocks where he or she is super specialized in. And then we build the conveyor belt.
Yes,
The thing that comes out in the end
Yeah.
is a reflection of the expertise of that team. Rather than one person say, oh, I think India's GDP growth will go to 10%, so I'll buy only banks and stuff like that. See, we all, I think, should realize that building a portfolio on macro basis is very risky. Which is why also as a DNA, we don't try to take very high sector deviation. We don't try to be very stylistic. We are not like super growth oriented. We are not super value oriented. We are not super thematic oriented. What we try to do is within a sector style, try to do good bottom up work, get specialists who are focused on that sector, and then the output will automatically be good, we feel.
So, just to kind of expand this point, is it fair to say that then the fund manager is only taking allocation calls, which is how much of which stock to own, and which stock to own actually is coming from the
No,
research team?
so other philosophy we have is to keep research and fund management independent, because we don't want to mix responsibility. So the way I think about it is, if you take the analogy of cricket,
Yeah.
the research team does all the nets, does all the coaching of the fund manager. The batsman goes out and makes runs.
Yeah.
So the fund manager is still very important, because ultimately in the macro context against peers portfolio, the fund manager has to create a portfolio which works. But unless the team supports him, the batsman will not score runs. That's how I think about it. Both are important.
Yeah.
It's not that we are saying the fund manager.
Someone who's front of the camera and someone who's working.
Yeah.
behind.
So, for example, we don't force a fund manager to buy what research team likes. Similarly, we don't force an analyst to like what a fund manager already owns. Sometimes there's a lot of pressure when a fund manager, let's say 5% in a stock, and he's a very senior person. The analyst is kind of under pressure to put that as an overweight in his own model, in his or her own model portfolio. But we are very conscious that we want analysts to think like, we want fund managers to think on their own, analysts to think on their own. And like banking, you have this maker checker concept. If by their own independent decision, they both like the same stock, which will lead us to a situation where the hit rate will be very high.
In any case, it will be a collaborative process.
Yeah.
While you're saying keep isolation,
we'll allow them independent thoughts.
Yeah.
But we also trying to build a culture where they informally collaborate, and there is good exchange of thoughts.
And where is Manish in all of this? Is the captain of that team?
Manish is trying to become redundant in one sense. That's I think the ultimate leadership mantra, right? That you build a team where you don't have to do too much. No, but I do manage funds. I think any senior person in an investment team has a big responsibility of mentoring the analyst, because you need to ask good questions to the analysts, which are provocative, which make them think. So yeah, to me, my role is basically to get up every day and think about how can I make this department better. So it could be process, it could be questioning analysts, it could be discussing with fund managers, but there's not too much of structured work, hopefully.
Great. Okay, so let me get into markets, which is why we are here. Manish, if I look at global markets also, but let's talk more Indian markets. The markets have been extremely resilient, and although each subsequent month when I talk about, I say so volatile, and the next month something more happens. Okay, unfortunately though, but it happens. The last 6 months have been extremely volatile, and the kind of geopolitical tussles that we have seen in such a short span of time, I think possibly, I don't know last when we would have seen where something is happening in Europe, Middle East, things got escalated so much. There was something happening, at our borders itself, and markets are rock solid. Uh, do you think markets are discounting or rather underestimating the geopolitical risks that we are living through, or as always markets are always right?
So a lot of things are a bit clearer on hindsight. So to be honest, I've also been surprised. I thought this calendar year positive return is very, very difficult, because I think we have 6 or 7 calendar years where we've been positive. In general, once in a decade, you get some shock where you get a big drawdown.
Yeah.
I was having the view that, and maybe it still happened, but I don't know. Markets have been stronger than I thought. Having said that, part of it structurally, I have believed in something which to me makes this more acceptable. And the second thought is something again where it was a bit nascent, but now it's building up. So I'll explain a bit about this, right? So the structural thought I've had for last couple of years has been that India is in a once in a generation kind of macro improvement, which will mean that our P multiples will remain higher than historical levels. Why I say that is, in one sense, at the core of fundamental investing is cost of equity, because that is the kind of return expectation which we discount cash flows of companies at, right? So let's say 10 years back, if some analyst was doing cash flow discounting of Infosys or HDFC Bank, to my mind, cost of equity in India would be 13-14%. And that typically has three components for me. One is the US interest rates, which is the risk-free interest rate for the world, plus rupee depreciation, plus company risk premium. So let's say 14 was, let's say 5-6% US rate, 4-5% rupee depreciation, 4-5% risk premium of the
So
company.
15% return चाहिए.
हाँ. So what I have believed for last 2-3 years is that 5% or 4% rupee depreciation will come down to 1-2%, because I think that once in a generation improvement is that India's current account deficit to me is zero today. Because it gets reported at 1-1.5% of GDP. But again, I have felt now that gold should not be part of current account, which they report. So gold is part of current account. To me, it is a capital item. So if you remove that 1% roughly, which is gold purchase, then we are virtually zero. And we are likely to be in good shape, because if you think about our biggest export is services, which has doubled in last 4-5 years, likely to grow somewhere between 8-10%, I think, for next 5 years. And our biggest import is oil, thankfully for us, because of renewables and EVs. Oil prices are likely to be range bound, in which case that will grow at 3-4%. So if your biggest export is growing faster than your biggest import, and you're starting with virtually zero base, then you're likely to be in good shape, which is very different from last 30-40 years, where India had a current account deficit of 2-3%.
Perpetual,
So this very, very important, significant improvement should show up in currency strength. So relatively, I have felt that 4-5% will become 1-2%, which basically mean that 14-15% cost of equity is now 11-12. That typically means your P multiple will be 15-20% higher. So that is something which ties in with this market resilience, although I've been surprised at the extent at which it has played out. Also, the market resilience is global this time. So S&P 500 just about hit all-time high. So now the nascent theory, which we'll have to see how it plays out, is I think globally investors, and I may be sounding very cynical about this, I think at least a certain section of investors are now beginning to believe that paper currencies will be debased. What we mean by debased is basically governments will print far more money than they
So there is a risk to value of paper currencies.
Yes.
Exactly.
Yes. Because see, most governments have debt levels which are far beyond reasonable levels. They are typically at levels where they were in World War II in US, for example. And when you add the fact that generally growth is likely to be weak given demographics and maturity and scale, it will be very difficult for developed world governments to service the debt unless they print money. Print money obviously happens every year, but they'll probably print money more than what people expect. Which is why I think gold and Bitcoin are also probably doing well. So I think there is some big money globally which is now beginning to believe more and more firmly that this debasing of paper currencies,
There is some chance.
basically, you should own either growth assets or hard assets
Yeah.
rather than owning anything in at least low duration fixed income, like the savings account
Yeah.
or 1 year FD. That will not protect you from inflation because governments will keep interest rates below inflation, what we call negative real rates.
Yes.
And the classic leader of this trend has been Japan, right? Because last 15, 20 years, Japan has had negative real rates. Very interestingly, today, Japan and India have the same inflation, but our 10-year yield is 6%, there is, I think, 1% or something, right? So I think that distortion people are now expecting will happen globally. And I think if you see markets have probably derived some strength from Mr. Trump's statement that Fed should cut rates.
Yeah.
Actually, theoretically, I don't see any basis why Fed should cut rates because we've not got a single reading below 2% inflation, which is the target.
Yeah.
So if US is building towards a scenario where you're going to cut rates even before one single reading of inflation below 2%, I think some big money is believing that this is the start of a long period of negative real rates, and US, obviously the size of that economy, the size of its role in capital markets so big that maybe Japan, when it did this, people did not pay so much attention to it.
Yeah.
But if you imagine that US starts running very large negative real rates. So let's say inflation in US remains 2.5, but the short-term rates come to 2%.
Yeah.
Then I think equities will do well.
Yeah.
Because that's the one.
This is a statement I was looking for, that to kind of convert it into actionable is when you mention growth assets, etc. If it were to happen, then equities are the place to be, or then real physical assets are the place to be, which for most people it is difficult to trade, but equities is something. But you mentioned something which kind of spooks me, so let me just clarify it. You mentioned Japan, and whenever I think Japan, it is 30 years of no returns. So let me just clarify. It was only in the context of very high debt to GDP and nothing else, right?
Yeah. No, but see, you have to nuance that part a bit. See, the 94 bubble was so big, the next 10, 15 years they struggled. But if you see last 10 years, for a country with virtually negligible real GDP growth, nominal GDP growth of maybe 2, 3, 4%, 10-year return on Japanese equities is 10% CAGR, which is almost same as Nifty, right? So yeah, stocks in Japan have worked. It's just that the 94 bubble was so high that the 94 to 2010, I think you should just...
When the Emperor's Palace in
it
Tokyo
was worth more than California. Yeah.
So I kind of buy into this argument of what happens if there is a global currency debasement or there's a risk to dollar. But I also have a flip side argument to it, which is that for whatever said and done about US and whether it is on the trade side, whether on the monetary fiscal side, whichever, what is the alternative that the world has? Because that is the only currency of scale, currency available in scale.
Look, you can remain the reserve currency, but you can depreciate 30-40%. So if you see the dollar index in, let's say, 2007 or some cycles before that, when emerging markets have done well, the dollar from the top has fallen 25-30%. It does not mean that I am not of the view that's going to lose reserve currency status in the next 10 years or so.
Yeah.
It will still be the default currency we will all use.
Yeah.
So that argument is separate. The simple argument is that, like any other currency, I think it's an overvalued currency because it has 3 to 4% current account deficit. It has a fiscal deficit and government debt, which is very spooky. It has inflation, which is relative to developed world, it's quite high, right?
Yeah.
I mean, Chinese inflation is much less than US inflation.
Yeah.
But Chinese yuan has depreciated maybe on a 2-year basis. So I think that currency shows all fundamental signs of overvaluation, which
If
is
it
not
was,
which is not to say that US will do badly or it will lose its
Hmm.
reserve currency status. It is just that it has had cycles of 20-30% fall. I think we probably are in the midst of one of them.
Okay. Okay. So if I kind of lead that on to how you are thinking about markets as of now, and before we started shooting, we were just chatting that at the beginning of the year, and I just realized it is half of the year is already gone. So today is 30th of June.
Yeah.
So beginning of the year, we kind of, all of us were thinking that this will be a tale of two halves, because beginning of the year the market was quite shaky. So first half possibly wouldn't do that well, and the second half might do a little bit better. Uh, First half, okay, flattish.
Yeah.
We can't say it's done bad, but flattish, maybe a little bit positive. How are you placing yourself for the second half? How is second half looking like right now?
As we discussed, I'm also a bit surprised because you can be structurally bullish, but after 6-7 years of very strong returns, you would expect some big correction to happen.
Yeah.
And we look to be getting that, but then the rebound has kind of surprised, I think, all of us.
Yeah.
Um, Look, it's difficult to say about next 6 months, but in general, our view has been, or my view has been that structurally it does make sense, I think, to be in small caps, which is a bit of a contrarian view to probably what the industry is at
Oh,
this
wow.
point of time.
It's against our house view also. We are also not too bullish on small
No,
caps.
so the whole point that, look, so low growth meeting high liquidity, I think is a recipe for small caps to do well. Because I'll tell you why. See, low GDP growth, what I mean by low GDP growth is last 25-30 years, global growth was 3.5-4%. I think it will probably be 2 to 3% now. Given all the demographic issues, the trade issues,
Yeah.
that free trade is not happening and all that. And that way, even India's growth then can't be 8, 9, 10% to my mind. We'll be 5.5 to 7.5% range, depending on the year. And our nominal GDP will actually come down because our inflation's come down.
Yeah.
So I think we are now at 10, 11 kind of
Percent
nominal GDP versus
which we used to be
13,
15% nominal.
15, whatever.
Yeah.
Now, you would think that's bad for equities, right?
Hmm.
Because nominal
Nominal
GDP
is-
going down obviously pulls down corporate earnings. But at the same time, you have a cost of equity going down, which pushes up P multiples. But the thing is, when broadly GDP growth slows down, the big industries will invariably suffer. Because if bank credit was growing at 16, 17%,
Now 9%.
now it'll grow at maybe 1% more than nominal GDP, 11% or whatever. But fair amount of decent. So, however good a bank you are going to suffer in terms of fall in growth.
Yeah.
But see, small caps, they are basically, and if you obviously pick them well, they are at the cusp of change. So, a EV company or a renewable company or a company benefiting from China plus one or a company benefiting from global defense expenditure going up, that is not going to face those challenges, right? In fact, for them, growth is accelerating, right? Now, typically, why have small caps been risky? Because you keep getting liquidity shocks and therefore they fall 50-70% in a big liquidity shock.
Yeah.
But if our belief is that there is definitely an improvement in India's macro, which is going to pull in both domestic and foreign money. And B, now the nascent thing which is happening, which is the dollar depreciation and the debasement of paper currencies and all that, that liquidity shock is unlikely. It may come from non-economic sources, like tomorrow if a COVID equivalent were to happen, yes, small caps will fall 50%. But honestly, no one can build a portfolio
No.
for COVID or war.
Yeah.
So we can build only
What you can predict.
for economic reasons, right?
Yeah.
So if we see too much leverage, if we see interest rates going up a lot, we can be cautious about small caps. But do we see that? I don't see too much leverage in the system. I don't see governments have any incentive to have positive real rates. So, I think nowhere in the world today can you keep money in the bank for 1 year and beat inflation, right? For India, it might be post-tax basis, but as I said, in Japan, your inflation is 3%, your 10-year yield is 1%. How the hell will you make money by putting money in the bank?
Yeah.
Right? So there is a lot of incentive to move into risk assets. So if that sustains, which is often, so low growth, low GDP growth, meeting very high liquidity, means that growth is available only in niches which is small caps, where there's a tech change, some geopolitical change. Therefore, if you're able to play these themes, and maybe you need to be nimble because the price discovery is so fast, they go like 2x, 3x in 2 years, and then the theme dies out.
Yeah.
So we've seen defense, power capex, diagnostics, all have their cycles.
Yeah.
But you need to be nimble and play these. Otherwise, the big industries will not, to my mind, give you any big return, which is my issue about large caps.
I have two questions on what you just said. A, because safe assets are not giving decent enough returns, will it push people, including fund managers, towards irresponsible behavior?
Yes.
A. B, if your thesis on small caps plays out, would they get so much overbid that the valuations will be just out of whack, and hence the chances of accidents increase?
No, fair. In fact, as I said, just because I'm structurally bullish doesn't mean that every 6 months or 12 months will make high returns. And I've been telling my team, distributors, investors that today, if you want to invest in small cap fund, come with a 3-5 year view because next 6 months can be treacherous, which has not played out. But I think if you have funds which have done 30-35% CAGR for 3 years, you should warn investors that that return obviously is not sustainable and you may see some correction. So yes, I think to a certain extent that is already happening. As I said, I think 50-70% of small caps are overvalued. But unfortunately, the pace of this negative real rates and currency debasement, if US president wants to remove a very credible central banker and talks about 1% interest rates,
Yeah.
I think it is very scary in one sense, but good for equities in one sense. So I totally get you, and I can't deny that this will finally lead to a massive overvaluation in equities and maybe a big bubble burst few years down the line. I don't think we are there, obviously, because 1 year return on small cap is still negative or zero or something. So, and also other reason is, see, there are 600, 700 small caps we can look at. So we need only 50, 100. We don't need to be in
portfolio.
700 or 600.
No, and also from an
So what we think are overvalued, we can avoid and still own something which makes sense.
and from a end investor standpoint, what we also kind of suggest is, even let's say if you're not too keen or not too convinced about this entire small cap thing, the flexi cap is a very good way to participate.
I think someone who has 1 to 2 year time frame is a bit risk averse, should be in a fund which has 40, 50, 60% large caps, 40, 50% others mid. My only thing is the mid cap space actually looks as challenging as large cap in terms, they probably higher growth, but very, very high valuation, and there's not too much choice.
Yeah.
See, there are 150 stocks, they're quite crowded in by institutional investors.
All of them are well bought. All of them.
Exactly. So whereas with small cap, so for example, I mean, it is up to you to say whether it's a good cycle to play or not. But microfinance was in down cycle. It has recovered a bit. At least you get these down cycle stocks in small caps, right? Because there's so many cycles or so many industries which you can play. Whereas with the mid cap space, because it's only 150 stocks, that doesn't seem to give great risk reward. But I do think that you may find 50 to 70% small caps overvalued, but still be able to
Construct a portfolio.
which will do well, I think.
But one of the things which, when we interact with investors is because of this decent return phenomenon, if you remove the last 1 year or so, small caps have done exceedingly well. The AUMs of small cap funds per se have bloated like how?
Yeah.
So that married with, so per se this.
But I'm not of that argument I don't buy.
Okay.
I'll tell you why. Basically, I think you should see institutional money like MF money as a percentage of free float market cap of that segment. So when we see large cap, we should see what is the large cap AUM of the MF industry as a percentage of free float. And obviously large cap is very liquid, so we don't have a problem.
Yeah.
See, the good part about small cap is because of these IPOs and sell down by private equity, etc. The free float is also increasing.
Okay.
And my submission is that if I were to take the absolute amount of, let's say, rupees crore by MF industry into small caps as a percentage of free float of the small cap, I think it's better than mid cap. I don't have a precise number, but bottom up, I still feel that there is more crowding in mid cap because of the number of stocks being limited rather than small cap. Of course, the challenge with small cap is for the same free float, you need to own 10 stocks versus 3 mid caps.
Yeah.
But that is something you can get around by investing in research.
That is stock.
You should cover the stocks.
Stock as a dream.
Yeah, it is. It is. So, but you need to invest in covering those stocks, right? You need to invest in understanding those stocks. So it's harder work in one sense.
Which brings us back to your first point that your research team is strong.
Yes.
I know how everything is correlated. So last question, Manish, which sectors per se are looking, I know I cannot ask stocks to you, which sectors, which themes are looking interesting at this point
So
in
the
time?
3 themes, I think again, medium to long term, I'm very excited about. So one is technology penetration in India, which is internet platforms and software products are the more obvious things. But also I think in industries where some management teams can use technology better than others, that is part of this theme. So I'm a bit inclined towards not only internet platforms and software products, but just to see if, let's say, in banking or retail, someone who's got a traditional business model but is able to use tech better than others, because I think AI and machine learning and all that will create a lot of difference within the same industry depending on how the management team leverages this. The second theme is, I think India will become a big sourcing hub for complex products and services, not so much mass manufacturing, because anyway AI and robotics
Will disrupt it,
automate that a lot.
Yeah.
But if you want complex power equipment, complex robotics, complex contract research, complex pharma APIs, I think India will become a big sourcing hub. So whether it's engineering, pharma, defense, specialty chem, if someone at a reasonable valuation is available, where there's a moat, because I think people obviously will move out of China as in terms of market share. Right? India will get market share. And I think given India's scale of technical talent, that let's say if a Boeing or Airbus wants to design a aircraft component and needs 100 good aeronautical engineers, I don't think any small emerging market will have in one company 100 solid aeronautical engineers, right? Only China and India have it. You don't want to go to China, then you have to go to India. So, and in a way, the GCC growth is that, but obviously listed companies also will
Mhm.
take part in that trend. And the third is financialization, that people will move to more sophisticated financial products. So, uh, move away from savings bank balances to, let's say, arbitrage fund or equity savings fund. So the whole capital market versus banks, for example, I think
No, no. So
is a
that
good
also
thing.
we that this is one mega theme which we also believe in, is that shift from savers to
Yeah,
investors.
savers to investors.
Yeah,
Yes.
which is playing out in a big way.
Yeah.
We just saw, I think last week there was this report of now mutual fund assets have become 34% of banking assets, and it is just going one way. So that I fully agree with. But uh, uh, in light of some of these, let's say, internet, etc., themes, you said that one question which often comes to a retail investor's mind, or let's say my mind as an analyst, is that here also there is too much froth, maybe because of, obviously there's a lot of good work which is happening, but somewhat of overhype which gets created,
Yes. Yes.
over investment maybe which is happening. Uh, then how does one kind of select, because some of the stocks we know, so many years even after IPO they have not touched the IPO price. So how does one kind of select what is going to work?
No, where I think is a good filter to have is, you need to, probably you can be a bit late, but once you see someone becoming a winner take all in that industry, I think the margins will surprise people. So if you go back to the history of internet platforms, I guess couple of the matured
Sorry,
ones.
I just intervene for the benefit of our listeners. Manish has been one of the original .com entrepreneurs himself, so we must listen to him seriously.
I have
Please.
passion about technology, but
Yeah.
more as a financial analyst.
Yeah.
Couple of mature internet platforms in India are Make My Trip and Naukri.com. And if you see the margins today of these platforms versus, let's say, 20 years back, there was no way you could have predicted that like Naukri would have 50-60% margins, right? So I think these businesses are very volatile when there are multiple players. And you're correct that in a way a bull market is bad for these companies because the rivals get funded.
Yeah.
So if you're number one, but the number 2, 3, 4 are getting funded, then the margins will be very soft for next few years.
Yeah.
And maybe you can wait out those stocks where you see a lot of capital is entering that segment. But I think today, among the internet platforms which are listed, there are a few where I think they've gone beyond that stage where anyone can hurt them. Um,
So staying power is there.
Staying power, and as I said, once you have a situation where the leader is like 50-60% market share, and he doesn't need to bother about customer acquisition costs, etc., then I think the margins will surprise people. But having said that, yes, these stocks have done very well last 2 years. Our exposure is probably less than about it was 1 year back. We are waiting to buy them back at some point. And just like we saw correction 3 months back, we will, I think, keep getting opportunities where you can tinker your way up and down.
Yeah. Okay, great. So I think that with that we are at time. So we just hope that Manish and his team of the coaches and the batsmen will keep on finding these opportunities, and Bandhan Mutual Fund will keep on doing well. The investors will be happy if you keep on doing well. So on that happy note, thank you so much, Manish.
Thanks, Rohit.